Hey guys, welcome back. Today we are going to solve one problem from um, compulsory acquisition by the government. Okay, this is from direct tax CMA intermediate, and let's quickly solve this problem and get a grip out of it. Okay. So what they have said is Sunil. Okay, Sunil has a house property acquired on 7th July 1995 for 3 lakh rupees. He incurred improvement expenditure on such property 70,000 on 2000, 50,000 on 2010. Okay, again he incurred 50,000 expenditure on improvement expenditure on 2010. Market value of such property as on 2001 is 4,50,000. Okay, on 16/8/2013 such property is compulsorily acquired by the government and compensation decided by the government is 11,50,000. Right, then 20% of the compensation received on 24 and the balance on 25 on further appeal. Okay, yes, received as a price for compulsory acquisition is 11 lakh 50, but he feel like this is very less, so he took a litigation to the court and he received the excess compensation of rupees, enhanced compensation, which is 2 lakh, and he incurred expenditure of 11 lakh. This is the expenses related to that further litigation. Okay, compute the income taxable under the head capital gains. Okay, income considered to be income under capital gains. Okay, they have given the cost of inflation index, everything they have given. That's it. Fine, let's quickly get into the problem. Okay, Sunil has a property. When did he acquire? He acquired on 95/96. Cost of acquisition rupees 3 lakh. Okay, then improved expenditure on such property, which is 70,000. Cost of improvement rupees 70,000, which is happened on 2001. Okay, on 2001 for 2001, no, the fair market value they have given, which is rupees 50,000, not 50,000, which is 4,50,000. Okay, 4,50,000 they have given. Yes, then on 31st on 16/8/2013 such property is compulsorily acquired by the government. Okay, government has compulsorily acquired. Before that, he has incurred expenditure of 50,000 on 2010-11, which is rupees cost of improvement, which is rupees 50,000. Then 2013-14, which is the transfer happened, compulsory acquisition happened by the government, which is for rupees 11,50,000 the government has acquired. Okay, compensation decided. Okay, this is the kind of sale price. Okay, this is kind of the transfer price, full value consideration. Okay, then 20% of compensation received on 24 25 and balance on 25/26. 20% compensation, 80% compensation received. Okay, when he was receiving the 20% compensation, he will be paying the tax on LTCG. This point you have to note. You have to take a note. But we don't involve this step in the problem, but we have to have a note about this in our mind. Okay, so the next is further appeal. He went on further appeal, which is on 25/26. Okay, and he got the 2 lakhs enhanced compensation. Okay, and he incurred rupees 11,000 as expenses. Right, so that's it. We have arranged everything, so we have to find out the okay, so let's quickly prepare the table. Computation of capital gain. Okay, so what's the full value of consideration? Full value of consideration is 11,50,000 minus expenses incidental to transfer. So there is no expenses incidental to transfer when it is happening. Okay, so 11,50,000 is the net value consideration. What's the indexed cost of acquisition? Why indexed? because it is the transfer happened on 2012 13 13 14. So at the time there is that we have interest cost of acquisition and interest cost of improvement also there. So interest cost of acquisition is 4,50,000 into divisible by 100 into divisible by 100. On top of it we have 200 as value. Okay, then how much we have spent on 50,000? We have spent 50,000 on 2010. No, so 2010 the value is on the index is 167, and then the current year is 13 14, right? Yes, done. What else? Here 4,00,000 into 220 divisible by 100, which is 9,90,000. 50,000 into 220 divisible by 167, which is 65,868, which is LTCG 11,50,000 minus 9,90,000 minus 65,868, which is 94,132 is the LTCG. We earned this LTCG is partly paid, which is 20%. When we are receiving the 20%, you know, when we are receiving 20% is how much? 11,50,000 into 20%. We are receiving on 24/25, right? 50,000 into 20%, which is, while we are receiving 2,30,000 as the first payout from the government, we have to pay the tax on this LTCG. Okay, right? Then how much the enhanced compensation he has received? LTCG on enhanced compensation. Okay, so what's the enhanced compensation? Federal consideration is 2 lakh he receives later. Then he has spent expenses, which is legal expenses. He is paid for 11,000. The net amount is 1,89,000 is the net value of consideration, which is LTCG. He has to pay tax on this amount. That's it. The problem is over. The only thing we have to understand is the indexation happens. No, indexation stops till the transfer happen, not when the amount is receiving. So yeah, I'll give a note. Transfer happens not till when we receive money. Okay, that's it. Thank you.